This is your host, Sean Kernan. Thanks so much for joining me today. Today's episode is an interview with Brad Weddle, a fellow independent advisor here in the Dallas-Fort Worth area that I've known for a few years. And I wanted to hear his story because he had a very successful practice, as you'll hear, over $100 million of assets under management at his previous firm. And he pulled the trigger on his transition almost perfectly timed with the top of the market cycle in late 2007. So as we all know, the following months and couple years were very difficult for us as advisors and our clients, so not the optimal time to be going through a transition. And Brad had spent, as you'll hear, about 14 years at one firm, so he was pretty ensconced where he was. So listen up and gather in his lessons learned, and without further ado, here's Brad Weddle. Well, today I'm joined by Brad Weddle. I've known Brad for about 3 or 4 years now and loved hearing his experience going independent at an interesting time that we'll talk about. So, Brad, thanks for joining me today.
Thanks for having me.
Well, Brad, why don't you give us a little background on how you got here, both in the industry and to the extent that you want to, kind of the background that brought you to looking at the independent model in general.
Okay, good questions. Well, I grew up and my family had no experience in investments. I was taking a college class, and the teacher said, you're going to purchase a stock and purchase a call option, which I knew nothing about call options and very little about stock. And then she said, whoever gets best returns gets bonus points. I thought, I may like those. I may need those. Well, that was 1982. I picked Walmart as my stock and Dr. Pepper as my call option. They came in first and second, respectively. I was hooked, and I started buying some stocks and mutual funds at that time. Going forward, I was working, as I said, I was in college, working full-time. Went to work for Texas Power and Light, which became Texas Utilities. They had a thrift plan that was a predecessor to a 401k. At the time, you could put in up to 12% of your money in it. By that time, I'd gotten married, bought a house, and was trying to go to college, and had actually taken a pay cut so I could finish college. I started with 4%, got a raise. Part of it went to taxes, part of it I call toys in life. Raised my contribution to 6, later to 8, to 10, to 12. Before you knew it, I was putting back 20%. I worked 9 years with Texas Power and Light, but after I graduated college, they transferred me, and I was into I'll call it part marketing, part engineering job. And when I moved, every firm in the world called to talk to me about investing and selling me mortgage cancellation, which is effectively life insurance. And so I just had an interest in investing and got actually a couple of my first licenses or registrations back in the late 80s. And in early 90s, Texas Utilities offered an early out program. And I wanted to do something different. I didn't know what. And here I am. I went to work full-time in this business in 93. And
I didn't remember that part about you getting those licenses. How did you procure the licenses then?
Well, a lot of the companies calling on me when I moved to Mesquite area in 87, I believe it was, were life insurance agencies. They were some broker-dealers, and they were trying to sell me life insurance a lot. And, it's a forced savings plan, and I'd heard the term buy term and invest the difference. And so I did that and followed the concept, and I actually got my licenses through the old A.L. Williams, which became Primerica. Going forward, when I started in 93, interviewed with a couple different firms, A.G. Edwards and Edward Jones, and went to work for Edward Jones and worked for them for about 14 and a half years and left in the great timing of December of 07. And came to my
very good. Well,
current.
What made you start looking around to kind of make a change? That's a pretty good stretch at one place, and I think you were doing pretty well from our conversation. So what kind of made you look around and tell us about that time and how that process went in exploring?
Good question. It was a accumulation of things over time. I was beginning to see some advisors retire, and we were told we didn't own our book of business and we couldn't sell it, and that nobody in the industry could. Well, as I did a little research, I found out that, yes, when you're independent, you actually own your book of business, and you have an asset that you can sell. In my case, I'll call that a pretty nice figure that a lot of people could retire on. In my other firm, we were a partnership, and you got a limited partnership based on your production, but also based on how you helped out in the region. But that was always an arbitrary number. It was, what do I get for training this person? What do I get for this? And nobody would tell you. I had
brownie points,
basically. I had
that weren't tracked.
A gentleman into my office, giving him part of my business, a very nice head start for him, and allowed him to build his. Well, he was to move out, and the plan was to be completed, let's say, by December, and his office was not ready, so I didn't kick him out the door until February. That April, they came around talking about partnership, and they said, no, you had to have completed the plan. I said, that's not my fault that it wasn't completed. And so I didn't get partnership that June when they offered her, not as much. I got partnership, but not for the plan that I'd done with him. And that was kind of the final straw. But it was an accumulation of more services to offer at my current broker-dealer, more investments to offer. I do own my book of business. I could recruit somebody and override them, share office space, etc.
Gotcha. And just from one step back, how did you build that business, and what kind of, how did you run your practice? What was your business model at the old place?
At the old firm, I literally built it from scratch. I worked in a town about 30 miles away and went to a small church here and knew a few neighbors, and that was it. So literally built it from scratch by door knocking and literally out knocking on residences and businesses and then just cold calling on the phone. At the time I was the second office in town for that firm, and there had been one or two that had failed in between, the first one and me. And I think when I left there were 6, and I actually checked today, they have 8 current advisors in this area, although I created a few of those when I left. They tried to obviously keep my book of business and split it up over several advisors. But I started from scratch.
And in terms of your business mix, what types of investments did you use and that sort of thing?
It has evolved over the years, and that's an interesting question because when I first started, a lot of the people I knocked on doors, I was their first step away from the bank. And interest rates were beginning to come down, but still a lot better than they are here in 2016. So at that time, we had insured corporate bonds, which do not exist. We had a government agency bonds like Freddie and Fannie and TVA. We had AAA insured muni bonds, which those have pretty much gone away as well. The insured corporates don't exist. Fixed annuities were paying much higher. So my business was probably 40% fixed rates, and then I did a lot of rollovers as people were retiring or changing jobs and roll their 401k to an IRA. A lot of mutual funds. Back then we didn't even have exchange-traded funds or ETFs. And prior firm didn't have some of the investments that we currently have that I could use now as well.
And this was all brokerage business, correct?
It was all brokerage.
Advisory wasn't,
it was all transactional, pretty much A-share mutual funds up one-time sales charge up front. No, you had the service fee, I guess, tied to the funds. The CDs or bonds, you got paid in a markup form one time. So you might do a 20 or 30-year bond and have a gross of 2 or 3%, but you had to give 60% of that to the other broker-dealer, which is interesting. One day I was looking at my profit and loss statement, which covered my office expenses, my assistant, half of the phones, because I paid the other half out of pocket, half of the postage, which I paid the other half out of pocket, and it covered what they paid me, etc. And yet after all of that, and my part of the home office expense, I still had anywhere about $150,000 worth of profit on my profit and loss. I kind of got to scratching my head one day going, gee, where is that money going? So now I get a larger portion of that in my pocket.
Right. Yeah, you had a little bit of I guess, the bonus calculation, but it was a lot smaller than that on an annualized basis.
Well, that's interesting you mentioned the term bonus. And I left the other firm in December of 2007, obviously walked right into a bear market of 2008. But my previous firm, yes, they did offer bonuses. It was a stair-stepped or staggered bonus system, kind of subjective. But in 2008, they did not have a bonus. So even though I would have been very profitable, I wouldn't have gotten a share in that bonus.
Yep. Great
they
point.
They would have kept all of that $100,000 or $150,000 worth of profit above covering all the other expenses and overhead. So here, I get to keep a significant part of that.
Now, when you kind of realized that this wasn't going to be the place you stayed for forever, how did you go about looking at the choices out there and what was important to you? And just tell us a little bit about the mindset and how you kind of came to a decision on a firm, and then maybe a little bit about how you plan to make a change.
Over the years, many firms had called. Back in the mid-'90s, Merrill Lynch had tried to do kind of the Edward Jones, my prior firm's concept of standalone offices. And Ameriprise had tried some, but every bank in the world had called me that had a broker-dealer. I've been recruited by a couple of other firms over the years. But I started looking probably fairly heavy in 05 or 06 and talked to several of your major firms, wirehouses, talked to some independents, and was just looking. I decided I didn't want to work for one of the wirehouses. I needed to stay here locally in the town that I'm in. We're a suburb of Dallas, contiguous to them, but we kind of have our own identity. And my prior firm has 6 other offices here. There's another significant, I'll call it, independent just down the street from me. So I wanted to keep a presence here. I wanted to be independent, to be able to control my own destiny, control my own paycheck, own my own book of business, etc. And as I got to looking and kind of narrowed it down to probably 3 major independent firms, as I looked at the technology, I looked at where their advisors had come from, and kind of their going forward, I chose this firm.
Very good. And, how long do you think it took when you had made that decision and, okay, you knew where you were going, and then, between, how long did you take? I know you're kind of a planner. You think way ahead. So how long did before you pulled the plug, and then how long do you think, if someone were, really gung-ho, like how long could it take? How short could you get that done?
Good question.
And kind of what was your experience?
Mine was kind of unique. I was about ready to move a year before I did. I had 2 different contracts in hand for various office space. One was in a multi-story bank building. I also looked at the only high-rise 7-story building in my town. I didn't like that location for a few reasons. And then I had another in a strip center that was owned by a church. And interestingly enough, the head of the church that I was dealing with was already a client of my firm, but with a different advisor, so I had to swear him to secrecy. But I backed out. I didn't move for a year, and I'd actually told the gentleman that I'd brought in to me, who was one of my replacements when I left. I waited a year, and unfortunately in this business you don't give a 2-week notice. You give a 2-minute notice, they come to lock the doors, tell fibs about you, make up stories, and obviously go after your clients pretty heavily, which they divided my clients over there between two offices and tried to give some assets to at least a third one, if not more. So I finally moved. But in that moving process, I found a location, signed a lease, and it was basically a shell. So I built it out over a 3 or 4 month period, ordered furniture, ordered computers, monitors, telephones, etc. So that was quite the interesting challenge versus I had a buddy that also left that firm after I did, and his was basically flip a switch and walked into a already built out office space, and he had to leave in a bit of a hurry, and so he didn't get to do quite the planning that I did up front.
Gotcha. And, maybe we'll come back to kind of touching on the pros and cons of those two choices, because I think one of the things I find exciting, and I think some people find intimidating, is sort of the unlimited spectrum of choice between what you described of building your own office from the ground up, from the shell condition. On the other side of that is the idea of plug and play. Obviously, there's some considerations about what that means, what you get for what you give up for the plug and play model. But I know you had built a pretty substantial business. Do you mind sharing kind of the kind of your asset production levels right before you left?
Good question. I know in around September of 2007, I had roughly $115 million, and that was after I'd given away $1.3 million a few years earlier and $10.6 million to the gentleman that I brought into the office. So from 93, I think my can sell date was August of 93, through, let's call it September of 2007, roughly $125 million. I think when I finally left in December with the markets headed down, not realizing how badly they were going to go down, I think I was between 110, 115.
Gotcha. Okay. So a pretty substantial business, and obviously financially you were in pretty good shape with that kind of asset base. So take us through the move, and I remember when I first heard this story, I think we were sitting at our national conference, and my instinctive joke was, well, why did you leave when the market was going to go down so much? That wasn't very smart.
You
should have waited.
Go ahead.
But walk us through that process, and I know you've got some lessons learned. But so give us a sense of pulling the trigger and what went well and what didn't, and especially with the person who, if they were to ever consider this, it's scary not having done it before for some people. So how did it go, and what did you learn?
Let me go back just a little bit. You mentioned the plug and play concept. Doing it the way I did, there is a risk of getting caught, and you would probably be asked to leave or forced to leave on the spot. But
sure.
Luckily I didn't. Sure. And that's an advantage in my office or in yours. A new advisor coming over could literally walk in the door. They could leave the prior firm, and then, as soon as their license transferred later that day or something, or that week, they could plug in, and ours is already set up with the desk, the computer, the software, and all they got to do is plug in and start working to get their book of business over. So that's
right. Very little infrastructure to establish.
A lot better infrastructure and plan, and they would have some help that I really did not, because I pretty much did it on my own at the time. So that part is good. I think the plug and play is a good way to go about it and have some assistance and not have to reinvent the wheel.
I guess the thing that I was referring to is there are a lot of folks out there, or at least some, that are already independent that set up the plug and play, and I think we've seen people try to establish what I would call a mini wirehouse. So the economics of that arrangement, still don't work, even if it's on the independent channel. But if you have someone that prices those services and the infrastructure correctly, and it's more of closer to a co-op model, where you're not giving up a huge chunk of the revenue to put you right back in the same payout boat, then then it can work very well. So I guess that's the big
exactly. I
caveat.
joined a hybrid RIA, so I'm part through the broker-dealer, part through the RIA for the advisory side, which, coming from my prior firm at the time, had no advisory business. And so that was brand new to me. It was big in the wirehouses, but my prior firm thought it was the world's worst thing in the world to have advisory and to have discretion. But yes, I joined the hybrid here, and it actually wound up getting a raise even from being straight with the broker-dealer, just because some expenses were cut. So that was unique, and had some camaraderie, had some training through the hybrid RIA, had some sharing of ideas, able to back me up if I'm disabled or out of the office for a week. So there's some certainly advantages there to plugging and playing. My timing of leaving, as I mentioned, I couldn't have timed it worse. The markets went extremely south during '08. I think from high to low, the S&P was down 57% in that year and a half span. And they put 2 advisors directly in my office, as I mentioned, and they got on the phone calling and had all kinds of help and stories. And they did a good job of keeping more clients than I would have liked to them. I probably got more, 70, 80% of the clients. Unfortunately, I only probably got 50% of the revenue. Now, at that same time, I know some clients left that prior firm altogether and didn't go anywhere. Some came here, some went to other offices of that firm, so they didn't all stay there locally. I had clients scattered through.
When you did the post-mortem, however long after, 6 months, a year, whatever it was, and once you realized kind of who was not going to come, it was probably giving them enough time and it was not likely to come at any point. Did you find any common patterns among who came with you versus who didn't, or was it fairly random?
That was interesting. I had made out a list before I left. I did not tell anybody that I was leaving. That was interesting. I told our best friends the night before because they helped us move. Interestingly enough, they were clients of another office because they had inherited some money that was already in that other office. But they helped me move. I resigned on a Monday morning at 9 o'clock or so, got a call immediately, drove 3 miles down the road and opened a new office and waited for my license to transfer, and it did around noon. And I sent out letters and started calling and seeing folks. I'd made a list ahead of time going, here's a lady, it was literally one of my largest, and her whole family throughout the country had been with that prior firm. So I really didn't figure she would come. And she didn't. The other one that was out of the country, I think he'd been with 5 advisors in the time I had him, so I would have certainly liked to have had him, but he was on the block, kind of on the bubble of whether he would come. Had another one, yeah, I'm the closest thing she's got to a son or grandson, she's coming, etc. I was pretty accurate on that list. I had some surprises, both good and bad, on that list of who I thought would come and who did not. But I picked up some clients here that one walked out there, they had a meeting, and they brought their sister with them, who was at a different office with that other firm, and says, she wants to move with you too. When I originally came over, I kept clients just brokerage and didn't evolve into advisory probably till several years later. And it's interesting, I met one of my former colleagues who was in a different office at the prior firm, and he had done a lot of fixed rates as well over the years. And when I talked to him, obviously fixed rates were basically paying nothing now, and the insured bonds, et cetera, had gone away. And I said, what are you doing? And he was doing a lot of dividend-paying stocks. Well, as an example, if he had 400 clients from those 400 in that stock, he literally had to call all 400 before he could make a change. That's not a very efficient way to manage a book of business. And unfortunately, when you're trying to call 400, that would take weeks. One client's in the hospital, one's on a cruise in the Caribbean. Here, with the technology and tools and the models that I've set up, I can literally push a button and in a matter of minutes have moved a client in or out of that particular stock or mutual fund or ETF. A much more efficient way of doing your business, running a business, and frankly helping your clients, when the markets are going crazy like in a year such as '08 or maybe 2011 or early part of 2016 even.
So do you find your clients miss having those calls where you to say yay or nay on every single investment? Are they okay with the new way?
That's an interesting, because even back then, I would say 90% of the clients, well, Brad, whatever you think.
Right.
Brad, that's why I've got you, make that decision. But even now, I stay, in contact with my clients through in-person reviews, internet, emails, phone calls, etc. And I do newsletters. I do some unique other letters to help educate and just stay in touch with the clients. And once I explain the concept of what we're doing, and this managed account as an example, they get it. And one of my programs that I do is designed to be really, grow and participate in the good years, but preserve more of the money as best I can in the down years. And the older clients really seem to appreciate that, and it's worked well. I can't imagine going back to the other way at this point.
Yeah, I'm with you. Yeah, I think the scalability and the flexibility and having discretion, it allows us to spend that time we're talking with clients, but it's talking about their goals and objectives, not about, the intricacies of what XYZ dividend is going to be, or, every little thing that we were kind of trained on in the early days to talk about with people. We can talk about their goals and more important stuff. So from a payout standpoint, let's say, we probably around 40-ish%, maybe a little bit higher when you throw in all the little extras that Edward Jones and firms of their ilk allow. You're a pretty detailed guy. Do you have a sense of, for a similar amount of revenue, what your net bottom line is after your expenses as an independent advisor?
Good question. Since you mentioned my prior firm, yeah, they said their gross payout was 40. However, there were several ways to get dinged from that and get reduced. And then, as I alluded to back then, I think it's changed, but you paid half the phone and half the postage. So you might have walked, and if you discounted a stock, as an example, you got penalized.
Yep.
I didn't do B shares, but if you did a B share, you got penalized, etc. So the payout in a lot of cases was maybe closer to 36 or something like that. Now, if you got bonus and I was a limited partner, yes, it was in the low to mid 40s maybe. Here, depending upon your setup, I'm in a standalone office. I'm currently the only advisor, and I have 2 assistants. One who's been with me 19, 20 years, and the other one about 3. Being in one office with one advisor, pretty much set up like the other firm, except I have an extra assistant, my overhead is probably a little higher than somebody that plugs and plays into an office where there's 2 or 10 advisors.
Right.
Economies of scale. Additionally, I spend a fair amount in marketing and advertising. That is one downside I found, is that probably most people do not know our firm. Of course, the clients are doing business with you, not necessarily the firm. But I would say I'm somewhere between 50 and 60%.
Right.
Net.
Yeah, I think that's a good guess or good estimation. It's funny, when I first was looking at all these options and talking to advisors, I was shocked that most of us as independent advisors, we don't have that number, nailed down, because, we look at it in terms of, net income and all, but it's just not a number that we worry about, because we know it's a lot higher once you've done all the math. And no one gives us a pretty report to say, oh, you had a payout of this, because we know what our top line payout is, and and we get to decide how to spend that money, how to invest in the business, et cetera.
Exactly.
And yeah, you've invested more than a lot of us in terms of having really good infrastructure and staff, and you got a comfortable space, which I think suits your business well. But and you can grow from there, as you've told me recently.
I probably do have a higher overhead and operating expense than the average being independent. One of the unique things, though, is once you cover all of those base overhead expenses, as an example, if I increased my revenue by $50,000, by $100,000, 80% of that probably goes in my pocket, or 90% of it at this point, once I've covered all those base expenses. So the payout can grow somewhat exponentially.
Right. It's more like a real business versus, at a traditional employee firm, you're always going to give up a half, or at least, or so, maybe more. But even as you grow, you're going to give up a significant percentage of your revenue. Whereas with a real, what I would call a real business, you have fixed expenses, and once you've covered those, then you have only some marginal expense to each new client takes on a little bit of labor, maybe, or some supplies, or some of your time, obviously. But yeah, I found that to be a huge concept as I looked at going independent, that it's not so much the existing revenue, it's whatever growth you have once you've figured out what model fits you, then the marginal impact on your bottom line is impressive.
There's an advisor that was at my prior firm, and he has a pretty bare bones office set up. And yes, his payout is probably in the 70s net of his gross. So yes, it can be done.
Now, if someone was listening to this and was considering their options, or saying, "Hey, why should I leave?" You said maybe you ended up in the early stages with, let's say, 50 or 60% of the assets that you had at the old place. Why don't you tell us, kind of, if someone was considering it, why would they make that move if you're going to take such a big hit? What's in it? What's the point of all that work if you're going to?
Good question. I think I got hit a kind of a multiple whammy from various angles. The timing with the market going bad. I had some clients that were deer in the headlight look, and they didn't know what to do. The one gentleman had already been in my office, so they put him back in there. There was some familiarity, I think, that some of the clients had. So I think that was a little bit of a downside. Also, I had a big book of business. I alluded to, I think there were 6 offices in town when I left, and I had a bigger book than the other 6 put together by assets and, I think, number of accounts. So they came after me pretty hard. Frankly, during the market's downturn of 2008, I was frustrated, depressed, and I think it kind of snowballs. I think in today's market, if somebody moved and is well prepared, they might see a much higher number, maybe 80-90% of their business coming over, and especially if their business wasn't as big. If it was a little smaller, you might have a bigger proportion come over. So I think mine was a little unusual in that they put several in my office. One had already been there. The markets were really bad, et cetera. But again, if you plug and play in an office and not trying to reinvent the wheel, I think you get some help on how to shortcuts to opening accounts, to processing the paperwork, et cetera. And, somebody that's already done this, I think in today's environment, if I did it again, I could probably easily move 80 or 90%.
Gotcha. And then since it's been a while, and obviously we've recovered from that market decline, talk a little bit about how your growth since then and your net bottom line, how you compare to where you were, at the peak of the market right before you left.
My production is probably up, 40 or 50% since then, even though I've got less clients and less assets. And it's a lot more recurring, a lot more consistent. I'm not having to start from scratch every day, every month. So I think that's a good thing. Having more services to offer was certainly a good thing, more ways to help preserve clients' money, more ways to diversify away from stocks and bonds. Those have all been good, and those were some advantages, and I frankly didn't even use them to a full advantage. And interestingly enough, I had a client that was referred to me, and he was getting what is called a structured settlement from an injury. Well, I had one of those at my prior firm, but we didn't do anything with them, so I had to refer him to somebody. We can actually do those at our firm. Most people probably don't even know we can do them. Somebody could build a whole career just on that. We've got advisors at this firm that build a whole career on doing nothing but setting up business retirement plans like 401ks. So the freedom and flexibility, if you want to be a true stockbroker, if you want to be a retirement plan advisor, you want to go do something like work the structured settlement market. That's unique, I think, to our firm, and the scale and size of this firm being the largest independent in the country, I think is an advantage to somebody looking to make a change. I only wish I'd done it sooner.
Agreed. And I think it's interesting to hear you tell that story, because for someone who doesn't hear kind of the rest of the story, so to speak, they forget that part about the growth you've had since the first 6 months or a year. All that growth, again, the as you've grown back and gone past your old revenue, again, that it's higher quality in terms of how it falls at the bottom line, and you're able to pick and choose what clients you work with, because you don't have to take everybody to generate revenue because of the profitability. So there's all these great things that I remember you telling me this story the first time we talked about it, and you seemed disappointed with your transition, but then looking backwards, I've never heard you sound like you regret it, right?
Correct. I was disappointed in my transition, and it was frustrating. Obviously, I think I could have done a better job, and it's turned out well. As I said, I wished I'd have done it sooner. As I go around to our national meeting and regional type meetings, I don't know the number, but it seems like a significant percentage came from our prior firm, and most left after year 3 or year 5 or year 7, and they kind of look at me and go, why on earth did it take you 14 to 15? Maybe I wasn't the sharpest knife in the drawer, but it's turned out to be a pretty good book of business. A unique lifestyle. You're own your business, but you're not out there totally by yourself. It's in a way like owning a franchise, if you can make an analogy to owning a Chick-fil-A or a McDonald's or whatever. So you've got the help and the assistance, and especially if you partner up or plug and play with some people. But yet you control it. You can work as many hours or as little as you want. You can choose what type of investments, we have no proprietary products, nobody telling me what I have to sell or do. Yet I do have supervision, which is a good thing, and plenty of ideas and assistance, back office assistance if I need it, and help and advice from vendors that bend over backwards to help us. And that's another thing coming from my prior firm. I think we had 6 to 7 preferred vendors when I left there. And really that was all I ever heard from, and I will say a couple of those were mediocre at best. Here, I just have to sift through which ones I want to use, because our selection and access to various third-party money managers, mutual funds, annuities, things like real estate trust and business development companies that we didn't even have at the prior firm. I just have to, select which one of those I choose to use. I think it best suit my clients. So.
Yeah, very good. One thing I wanted to touch on that you mentioned that's interesting, I made 2 moves, which I don't necessarily recommend, but it worked out for me. As if anyone wants to listen to episode 1 that hasn't listened to it, that's my story. But one of the reasons I was happy looking backwards that I did those was it was fairly easy to move my practice, right? Because it was a manageable size. Not that it's so big to that now, but it's bigger than it was. And so from what you just part of what you just said, is it a legitimate possibility from your experience and what I'm describing that kind of moving a smaller book earlier in your career, thinking about this from my perspective, it's almost like my clients had less time to get attached to a particular place, whether that was Edward Jones or Morgan Stanley. And I would think some of your clients got, so comfortable not only with you, but sort of the Edward Jones model that, inertia is pretty powerful at some point. You think that's a legitimate possibility that in that case, the time with one firm worked against you to some degree?
I do. I very much agree that it did. Having an older book of business, because I've been there so long, clients resist change. And people don't like to change, especially sometimes the older clients, which I had a sizable book of retired clients. So they had change in the firm that, I'd been with and promoted very heavily for 14 or 15 years. Change in location, although I'm only a few miles away from my prior offices. So that was difficult. I think there was another advisor, and from day one he had preached that they were his clients, and he just happened to work for that other firm. And he did a much better job of, you're my client, and when he left, a bigger percentage of them went with him. So yes, I think it's earlier. The earlier you leave is probably better. Now, I do think you have to have a book of business to be able to, support yourself.
Right.
You're going to have.
Well, there's a lesson in what you just said about that other guy. So maybe it's the making sure once we know what we're doing and we don't have to oversell the brand that we're with, just as an insurance policy, almost make sure we're explaining that we're try to sell the value of us, not of the brand. Once
Exactly.
After that first couple of years where you kind of need some help sometimes, but after that, make sure you're focused on that one-to-one relationship. That's a great point.
And that's the beauty of being independent. You can market yourself as your own brand. You can go under the corporate ID. You can co-brand, and a lot of people choose to market their own logo, their own brand, their own identity.
Right. Yeah, that's probably a whole episode into itself, talking about those options and the pros and cons of each. One of the big concepts I wanted to ask you about is how much time do you spend sort of running the business, and sort of talk about the reality and maybe versus some of the ideas that people might have of all the things that a firm might do for you in terms of technology and getting and keeping an office and ordering supplies or whatever the things that we kind of picture that it's so valuable to have someone take care of. How much time do you really spend, quote unquote, running the business? Because I think there's some scare tactics that would make people think, oh, it's too hard and you can't do it, Mr. or Mrs. Advisor.
Well, I think some of that depends if you're coming from one of the major wirehouses like a Morgan Stanley or a Merrill Lynch, because the firm is in some high-rise office building, and that office, the air conditioner goes out, the firm is taking care of it, or the building supervisor is taking care of it, as opposed to being with prior broker-dealer that I was, where I was a standalone office. I indirectly had to deal with, the air conditioner's broken, the water heater leaks, or something along those lines. So not a big difference from that aspect for me moving. That may have changed a little bit over the years. Yes, you are running your book of business. You own your business. And I lease a space, so, there are things inside. If light bulbs need changing, I have to change them. But I did that at my prior firm. So there are sometimes restraints, I guess, or constraints, as far as I have to pay the staff. Well, I hired a bookkeeper. She figures it up. I could let her write the check. I write the check. Want to go buy office supplies? I either order them online or send one of my assistants, or I do it. But frankly, I had to do that at my prior firm as well, which is interesting. Excuse me. out of that 40% that the prior firm was saying they were paying, if I bought pencils, pad, tape, staples, I paid for those of the other firm. So, again, that ate into that 40% that they said they paid you. And here, I write it off. It's a legitimate operating expense, and yet my net pay has gone up even after all of those. But yes, the day-to-day running of the business is a change you have to get used to. Again, I think that's an advantage of joining a plug-and-play situation maybe, where somebody else is already taking care of that. In my situation, I am a standalone office, so if the trash needs taking out, I've either got to hire somebody to do it or I do it.
Right. And I think, the big lesson or concept that's really important is that we get to decide those things.
You do.
From having 2 assistants or 6 to having 0 and doing all your own paperwork. And, we see all kinds of combinations in terms of what people want to do. And, then we're able to change it if we decide it's not working. If we need more support, less support, fancier offices, simpler offices, we get to put our own stamp on. And to me, that's the true definition of being independent. And I think I did an episode in the last few about that, sort of how to define, what does being independent mean, and, hiring your own staff or not, and picking where you work and what kind of tools you use. Those are big components of how you run the business.
It's interesting. I've got 2 friends who have come from other firms that are at my current firm, and one of them works out of his house. His business is, by assets, probably half the size of mine, but he doesn't have any overhead. And he loves it. He makes, good living, certainly higher than that previous 40%. I've got another one who has a lake property. He can remote in from his lake house. Clients don't even know he's not in physical location. He can be out on his boat. He can be sitting out on the patio. He remotes in. He works. And yet he has office staff and the typical overhead. So totally opposite concepts. And yet both of them are doing very well and better than they did at their prior firm.
Yeah, and probably a lot happier, given that the freedom to create their own ideal business.
Much happier.
Great. Well, Brad, I really appreciate you taking the time to talk with me today. Is there anything we haven't touched on that you'd like to share, or anything, if you had to do things over, that we haven't talked about, what would you do differently, or anything else that you want to mention?
I would say just, make a plan and work your plan. Visit some offices of the firm you're looking to move to. Ask questions. Find out the pros and cons. I'm open to somebody calling or coming to visit me, and I'll, try and answer any questions and share with them as best I can to what I saw as the pros and cons of making a move. Obviously, mine wasn't perfect, but yet I'm happy. So.
Awesome. Well, I really appreciate that. I'll make sure in the intro or outro that we put your contact information so people can find you, and especially if they're local to Dallas-Fort Worth. I think that'd be a great thing to do. Thanks again for coming on. Appreciate it.
Thanks, son. Have a good day.
And there you have it. Hope you enjoyed the conversation with Brad. Great insight from someone who's been independent for a few more years than a lot of the folks that I've talked to here on the podcast. I especially liked hearing his experience kind of growing the business back after what he called a disappointing transition. And I work with Brad fairly closely, so I know he's got a very successful practice. He enjoys what he does. And I think that's a great example of, even if things don't go perfectly, the flexibility and freedom that an independent business and practice allows us is well worth whatever risks are involved in a transition. So if you'd like to get in touch with Brad, you can find him at bradweddle.com. That's BradWeddle.com. And until